over to Tanya. Now, Tanya, we've had some questions from some of our brokers that I would like to kind of ask you and hear what your responses are. So the first one is, what are the key takeaways from our latest commercial market report, and how do they align with trends in the wider?
Perfect. Yeah, I'm happy to answer those questions, Michelle. Our latest commercial market report takes the findings from two independent surveys to bring together market trends. And the areas that we have focused on is office space insights and also retail and distribution trends. And the first takeaway that I would like to point out is that we're seeing growth and continued growth actually into returning back to the office. And that's an interesting conversation, isn't it? Because we've been out of the office, back in the office, out again. But newsflash, it's time to get back into the office. That's what we're actually seeing. But businesses aren't just settling for any old office. Where we're seeing the demand in office space is in high quality office space. And that's really important because the opposite is what we're seeing in low quality office space. And actually, our research shows that 82% of commercial property professionals believe that office space is a good investment now and in the coming 5 years. And 33% from the property professionals that we surveyed believe that revenue and yield is set to grow in this space as well in that same time period. But what we've done in the report is dig a little bit deeper as to what it actually means to be high quality office space, because that might mean different things to different people. So I'll take you through what they are, Michelle, because there's 5 top aspects for a high quality office space. Number 1 is energy efficiency. That conversation has been really long going as well in the sense of sustainability. Well, absolutely, if there's 2 office spaces that are available and one is energy efficient, that's the one that businesses want to work with. Number 2 is technology. We want to be able to work in places where technology is easy to access and fast for us. Number 3 is wellness. We spend a lot of time, don't we, at work, and so it's important to be balanced. So that might mean that in the office that you work, you expect there to be a gym or maybe a prayer room. Number 4 is good communal spaces. We all want to have a meeting where we can talk with our colleagues, we can get creative, and even get a decent cup of coffee. That's important in the place that you work. I know it is for me. And then number 5 is provision of transport. If you take a bike to work, you want to be able to park it safely. If you take a car, you want to be able to charge it if it's an electric car. So these are the things that are really important for high quality office spaces. And actually the research aligns with the market absolutely completely, because yields in the office space sector have been resilient and consistent across the board. And I was reading a Savills report just this week, so it's a very recent report, where they note that there has been growth for the last 5 consecutive months in this space, which we haven't seen since 2011. That's quite significant. The other key takeaway is around retail and distribution. Obviously, retail and warehouses are connected. Retailers sell and then they have to stock their items in warehouses and things of that nature. We've seen a decline in the last 2 years in retail sales, but actually what we're seeing now is an increase. It's a really small increase, so we have to use the words optimistically cautious, but no, albeit we have to recognise that there has been an increase. But actually, similar to the high quality conversation that we just had about offices, retail that is standing out is high quality retail. So it needs to be a high street with good foot flow, or a high street retail opportunity that perhaps has a mix with hospitality near it, or leisure, or even a little bit of residential mix in there as well. But it's good to see that the high streets, some high streets, because again, it's not all cities and it's not all high streets, but some high streets are making a comeback. And in our market report, 79% of commercial property experts believe that a retail shop or a semi-commercial shop is a good investment. And even higher, at 83%, believe that buying a warehouse or that type of asset is even more advantageous when it comes to yields and investment long term.
Thank you, Tanya. Next question, what opportunities do you suggest our brokers should promote to their clients, and what is the reasoning behind this?
Yeah, well, there's loads of opportunities that brokers can promote. And I'm going to use some words now that we are all familiar with in the residential space. So for, 10, 20, 30, maybe longer years, we have been refurbing residential assets, haven't we? Well, newsflash, refurbing in the commercial space is very, very relevant and a really good opportunity. And what am I talking about? I'm talking about an office block that might be tired, that needs to be completely refurbed. I'm talking about a pub that might need to be refurbed. Refurbing commercial assets is much more advantageous financially than building a brand new commercial asset. So refurbing this space is really important. And another word that we've thrown around a lot for the last 30 odd years is repurpose. But that's been quite significant in the last 5 years and is now super significant in the commercial space, repurposing your space. So that might be to add some commercial element or hospitality element. It might also mean offering an office space, for example, that caters to lots of different business needs. Some businesses want long-term leases. Some want to entertain co-working. Some want to entertain serviced opportunities in offices. So it's about having a mix and repurposing that asset that you've actually got. So that's the first opportunity for brokers to actually point out. The second is geography. It really matters. It has mattered for a significant amount of time with regards to yield. And so brokers and commercial investors need to be smart about where they are targeting when it comes to different cities. And in our market report, which is called Cities in Focus, we focus on Manchester, Birmingham and Scotland. But I'm just going to give you a statistic for Birmingham that just highlights the importance of understanding the geography of what you're doing. The office vacancy space nationally and in Birmingham is around 10% at the moment. So that's the vacancy rate, right? But in Birmingham city centre, where it's high quality office space, the vacancy rate is 2.97. So that really demonstrates two things, that knowing an area and knowing what you're looking at is really important, but also that high quality aspect that we were talking about earlier. I'll throw in just one last one, Michelle, and it's infrastructure, because in the commercial sector, infrastructure is important. If your customers can get to your business, guess what? They'll get to your business.
I know there's a lot of talk around cybersecurity, so certainly one that every investor needs to consider there. And finally, please, Tanya, considering these opportunities, what enhancements is Together implemented in their products, policies, or processes to optimally assist brokers and their clients?
We've been busy, Michelle, with our enhancements of this commercial product. But before I get into that, I just need to recognise that it's hard work, isn't it, for brokers to keep up with changing criteria and changing rates and changing policies and all sorts. We're not the new kids on the block in this space. We haven't just launched our commercial product. We've been doing it for a really long time. So we've got that experience and that deliverability. And we have got some pretty unique selling points already with regards to the way that we look at income, because we are super flexible with the type of income we take and the way that we assess that income. So we have 3 different affordability models, notwithstanding that we look at forecasted or projected income as long as it's plausible, sustainable, and it makes sense. So I just wanted to throw that in there as a given for the first point. But actually, and I'm going to refer to notes because I don't want to miss anything off here, we have been super busy with our enhancements. We have launched a flexible fee range. So an arrangement fee on a commercial term can be 2.5% or 5% or 7.5%. That gives the brokers the options to present to their clients. So that's a great optionality that we have exposed ourselves to. We've extended our internal fundings from 200k to 300k. That helps get those cases through even quicker. We've launched a semi-commercial product, so we carved that out of our existing commercial products and make sure it is definitive and it's on its own. That was launched in April. I think that was a birthday present from the products team for me, because I have been asking for a little while on that one. We have a 5-year fixed semi-commercial product as well. And I believe we have extended our loan size in this space on our product cards 4 times. So I think this time last year it said 250, then it said 500. It's 1.5 million today on the product cards, but of course we'll end up to £5 million on referral in this space. We've increased our loan to values from 65% to 70% for some assets. And we've got a VIP product, Michelle, between 250k and £1 million. So if there are brokers listening who are interested, please reach out, because I can tell you a little bit more about that VIP product. I'm just going to finish by saying a few other things. I've got 4 more things on this list that I wrote down this morning. Even though we have criteria that lays out exactly what we do, we always stretch it beyond that on a case-by-case basis. So where the split between resi and commercial is what the product card says, if it goes beyond that, we will review that. We often do. Where you want us to consider an investment value, it doesn't say that in our criteria, but if it's the right case and it makes sense, we will do that. Where you want us to do an AVM on a semi-commercial, it's not easy to do AVMs on semi-commercial. If we can, we would do that. And lastly, everybody knows that we lend on the 180-day on commercial assets. If there is opportunities for us to look at a different valuation in open market, again, it's not a regular occurrence and it's not easy, but if we can, we absolutely will.
That's fabulous. Thank you for that, Tanya. And in a couple of case studies that I'll share later is actually going to bring those bespoke agreements to life to really help you visualize what we can do. Great, thank you for that. And if anybody, as I say, if anybody's got any questions for Tanya following her session, please raise it in the chat box and then we'll cover it at the end. But now over to Dave Rowlinson on the property trends. So one of our first questions that we've had from our broker partners, Dave, is what advantages and disadvantages should an investor weigh up when considering a semi-commercial property compared to a standard residential buy-to-let property?
Great question, that. So invested in semi-commercial property typically involves a mix of residential and commercial. So a shop with a flat above. It does offer a different risk-reward profile compared to just a standard resi buy-to-let. The advantages of a semi-commercial property is a diversified income stream. So you're getting rental income from both commercial and residential tenants, and that then reduces your reliance on income from one single source. So just say one element of that property is vacant, the other may be able to generate income in that void period. So it makes sure that you're getting some rental income. An advantage also is higher yields. Commercial units often produce higher rental yields than residential ones, especially in high footfall areas. And obviously, if you've got longer lease terms, they offer greater income stability compared to a 6 or a 12-month AST. Another advantage is business rates versus council tax, because usually a commercial tenant will pay business rates while residential tenants pay council tax. So it potentially reduces your landlord liabilities. There's also tax advantages and stamp duty savings. Semi-commercial properties are usually exempt from the 3% stamp duty surcharge that applies to pure residential in the UK on buy-to-lets. And also commercial elements will allow for different treatments of expenses and capital allowances. Speak to your accountant on those. And also tenant responsibility. So if you've got a commercial lease, guess what? They often sign FRI leases, which means fully repairing and insuring, which means most tenants then will handle the maintenance, repairs and insurance. That clearly reduces landlord costs compared to residential lets. What are the disadvantages though of semi-commercial properties? Well, a lot of the time there's less mortgage products and they often come with higher interest rates or stricter criteria. However, that's where Together can assist, because we've got teams of great experienced underwriters who understand this product and then can tailor solution to your clients using our common sense approach. The other disadvantage obviously is a vacancy risk on a commercial unit. If the commercial part of that property does become vacant, it probably will take longer to relet than a residential unit. You've seen that sometimes on the high street, that it takes a good 6 to 12 months to be able to find a new tenant, and often you have to give some incentives to attract those tenants in. Management complexity. this is a really key one, because there are different tenancy laws and maintenance needs for commercial v residential units. Typically, commercial and semi-commercial units will require more active management, in particular on the legal side. For commercial leases, you can't just draw up like you can with an AST. Commercial tenants will require commercial leases, which needs involvement probably of your lawyer. And they may also need a change of use. So obviously the planning laws that are in place in the UK restrict use of properties. So just make sure that if you're looking to put a tenant in there, that it complies with the planning use that the council have granted. That compares to solely residential buy-to-lets, where there's always consistent demand for housing, for rental housing, especially in urban and commuter areas. And residential tenancies do tend to be more straightforward, easier to manage, easier to regulate. But what you do have is probably typically lower rental yields compared to commercial units. Tenants probably stay for shorter periods, but that could lead to more frequent voids and turnover. And increasing regulation, EPCs, rent controls could impact profitability. As I said before, stamp duty costs as well. Buy-to-let attracts a 3% surcharge on top of your standard stamp duty rates. When you're thinking of a semi-commercial property, what sort of considerations would I expect an investor to take into account? So, as Tanya mentioned before, location is key. So a semi-commercial property in a thriving area, such as a busy high street, will probably outperform a residential buy-to-let in a more stagnant market. Risk appetite, again, semi-commercial suits investors that are comfortable with more complexity and are willing to actively manage their portfolio. And then exit strategy. I do think that residential buy-to-lets are probably easier to sell due to a broader buy demand, but the returns that you can get off a semi-commercial property may outweigh that.
Thank you, Dave. What types of commercial security or locations currently present a higher risk for investors, and why? So based on what you're seeing with the valuation reports and trends.
Yeah, so another good question. So what we're seeing at the moment is a combination of economic, regulation, and structural challenges are sort of affecting different types of property and sectors. So where personally I see high-risk sectors at the moment, and Tanya's alluded to this previously, secondary offices, where we're seeing vacancy rates still remain elevated, in particular for those older, poorly located offices. We've seen the shift to hybrid working has impacted on demand. And we're also seeing rising maintenance costs and slower rental growth in those sort of areas. Prime offices, not an issue. They've recovered pretty well. But secondary assets face longer term obsolescence, if that's the right word, because you probably need to rework those assets in the short term, medium term, into something else, perhaps residential. And ESG, again, ESG is an important consideration on any offices. If I'm a tenant, or most tenants now are looking for what the ESG rating is of a property to make sure that it is, its rating is good. Other risks at the moment, retail property. So we've all seen the structural change due to e-commerce and shifting consumer habits. Many high streets and shopping centres have seen a drop in demand and footfall, and that's led to falling rental yields, tenant defaults, stores closing, longer lease voids. However, what I would say is that we're seeing some prime retail assets are rebounding at the moment, which is fantastic news. Secondary retail does remain vulnerable, but again, pick the right location and that should see you right. Retail parks with national brands and leisure, repurposing some of these shopping centres provide more leisure activities, temping bowling in there, restaurants in there, they're all attracting footfall, and that should have a positive impact then on the delivery and the success of the centre. We're also seeing at the moment is high risk is land. Issues around obtaining planning permissions, which are taking considerably longer than they used to, and other regulatory issues such as environmental, gateway, inflation, interest rates. Developers are finding it more and more difficult to take on new land acquisitions. So we just need to be a little bit wary of land transactions at the moment. But my advice would be to focus really on prime assets, get the location right where there's limited supply and there's going to be strong tenant demand, and you should be able to outperform the market.
And finally, last question. Can you provide any advice or tips to our brokers to share with clients who are contemplating entering the commercial property market, whether for investment or for start-up businesses?
I think the most important one really is to understand what your goal is. Is it income? Are you looking to increase your income and your rental yield? Or are you looking for capital growth? Are you trying to get a mix of both? And then consider when you want to do that. Is it a short-term gain? Are you looking for medium-term growth? Or is it a long-term play? So if you get your objectives right on day one, you'll understand then what type of assets and what type of investment criteria you're looking for. I think understanding the market is absolutely key. So we have seen that the UK market on commercial is due to grow by about 4.3% during this year. But commercial property is more cyclical, and you're also reliant on where the interest rate environment is, economic growth is, how people feel confident with a pound in the pocket, what they're going to spend it on. I think selecting which sector you're going to go into is key. So we know the commercial market is really diverse. You could go into offices, leisure, retail, industrial, but maybe pick a specialism. Yeah, perhaps look at where you see there may be future growth. So we've seen quite a few deals recently in the last mile logistics. We've also seen deals for data centres. And we are seeing that retail is rebounding, particularly in prime locations. So yeah, pick which sector you or your clients want to focus on and stick to that. Again, I'll talk about location. It's really, really key. So proximity to transport, proximity to population, proximity to key industries. They drive tenant demand. So that's really where you should be focusing the efforts. Areas where there's infrastructure. I know in Manchester, we look at what's been done there. There's just been an announcement today that the Metrolink is being extended to, I think it's 4 or 5 further places. So anywhere along those lines, we've seen historically that those areas have benefited from investment. So if I'm an investor now looking at that, I'll be looking at that announcement and saying, right, looking at Stockport perhaps as a location, because that's going to be an endpoint on that. That's going to drive investment into that area. So what opportunities are in that location? Tenant quality and lease terms. Again, I want to be able to sleep at night. So if I've got a strong tenant there on a long lease, absolutely fantastic. That gives me stable income. But what you want to do is when you're looking at an asset and with a lease in place, just look at those things like break options, rent review clauses, because they could come back and bite you at some short stage in the future. And always stress test against cash flow, against potential interest rate rises. I know the environment at the moment is interest rate reductions, but you just want to test if interest rates did rise by 1 or 2%, how would that affect my cash flow? Legal due diligence is also really, really key. So make sure you always engage experienced solicitors. They will handle your contracts. They'll look at your planning permissions. They'll do your title searches. And if you're buying a property, do you know what? I would commission a building survey just to uncover any hidden issues, any maintenance costs, any potential future expenditure that might come down the line and bite you. And market information. Always track market surveys. It's really important that you get the background information of what's going on out there. So whether that be from the RICS or valuation firms such as CBRE or Savills, get on their mailing list so you understand what's going on in the market. And finally, here's my pitch, find a good lender. Yeah, one who understands property, one who understands a borrower's strategy. Find a lender who's got a common sense approach to lending and one that is honest and transparent.
I wonder who that is, Dave. Thank you so much for that. Some great advice and tips there that you've provided. Again, if anybody's got any questions for Dave, please do raise them in the chat box. So I'm now moving on to some exciting behind the scenes reviews with our lovely Emma Goodyear, who is our senior corporate underwriter here at Together. So certainly get your pens and pads, writing lots of notes on this one to help you in assessing cases, although I'm sure with the fabulous sessions we've already had, your wrists are probably aching from lots of writing. But Emma, over to you, please. And I guess the question that we get asked quite a bit is, what specific information regarding company accounts should our brokers examine to evaluate the feasibility of a trading business's affordability?
Okay, so if a property's let and income producing, or we just look into the trading business to top up any shortfalls, we can just use accountant certificates as you used to. It's not such a problem. But where the serviceability is dependent on the profitability of the actual underlying business in such like an opco, propco situation, we would need to do a lot more analysis. So the more information you can provide us helps. 2 or 3 sets of unabbreviated accounts will tell us so much about a business. You don't necessarily need to get too hung up on the numbers because that's our job. But high level, we would be looking at the P&L to look at the profitability of the business, looking at year-on-year trends. So with turnover or net profits decreasing over time, or there's a sudden spike, if you could come prepared with an answer as to what the explanation of that is, or if it's a one-off occurrence or something's fundamentally changed, that's one quick thing that you can tell us up front, so we're not having to do whole loads of digging. We then use the balance sheet to explore the net asset position. We'll look at the debtors and creditor positions. So again, if creditors has massively increased, have you asked the question of why they're taking on more debt? How's that impacted on the day-to-day cash flow? And then we'll also be looking for things like, do their accounts kind of match the financial profile of what we'd expect to see for that kind of trading business? So, for example, if it's a haulage firm, is there a high level of asset finance funding the trucks? Or if it's a manufacturing firm, have they got invoice finance? If they haven't, why haven't? Is that a better financial solution for them than just taking out more debt with us? So then once we've got the accounts, we'll then use the numbers to calculate EBITDA, which I think a lot of you will probably be used to, but I'm going to dumb it down anyway. So that really strips out the non-cash items and demonstrates what the actual earnings of the business are then available to service our debt. So EBITDA is earnings before interest, tax, depreciation and amortization. So it's a simple calculation of looking at the net profit in the profit and loss, adding back your taxes, your interest, any depreciation and amortization that's been applied in those accounts. And then we'll use that as a simple calculation to say, right, how much is the debt costing? Divide that. How much is the debt? Divide that into the EBITDA, and it shows us a ratio of what can be paid. Within that, you can also look at any relevant add backs. So if there's been a one-off cash item, such as they've had to purchase some new machinery that's then going to sit in the business for the next 20 years, you could add that back in because that's not going to be an ongoing cash source. If they are using our loan to purchase a property when they've previously been renting, you could add back the rental income because that's no longer going to be an ongoing cost. And then once you put all that together, it's very simply, is that a 1.5 times ratio? And that meets our lending policy, and can the business afford it?
Thank you, Emma. And next question regarding investments. So that was trading businesses, but for an investment property, what essential details do you analyse in the lease agreement and valuation report, and why are they important?
Okay, so a lease agreement is important because it's essential to demonstrating how our loan or repayments are going to be met and for how long. So whilst the property might be income producing now, if they've got 100 grand day one, if that lease runs out in 2 months' time, it's not going to tick a box forever. So we would need that, especially as Dave said, on commercial stuff, because if a lease drops away, that property might take 6 or 12 months to relet. And what's the borrower going to do in the meantime? So specifically in the lease agreement, we'd be looking at the tenant and their covenant strength. Have they got the ability long term to service the debt? Is it a new startup business? Is it a one man? Is it just a one man band? If it is, that's not so much a problem if you're just a corner shop and you can easily get another corner shop in there. But if it's a 10,000 square foot office space, is that a tenant that we think is going to be in there for the duration of the lease? So that's the key thing on the tenant. Then again, the passing rent, how much rent are they paying and how long's left on that term? If it's a brand new 10-year lease and we think the tenant's really strong, we would then look to maybe tailor the loan in line with that, so that we're getting some repayments for the bulk of the income coming in. If there's more than one tenant, we'll do a WALT calculation to work out the average length of the term and the amount of income that the building is going to generate over the whole time, and use that to then do our calculations and work back from there on the structuring. We'll look at the break clauses. So you might have a 10-20 year lease, but if that tenant can forfeit every 3 years, then we would be looking to assume that will happen and do our calculations based on the lease dropping off after 3 years, not 20. And again, the rent reviews, are there any rent reviews in there? Usually they're positive, so it might be that the rent gets uplifted every 5 years, every 10 years, or it might be that there's been some agreement that the tenant's going to pay higher up front, do some work to the property, and the landlord's agreed that it could reduce after 5 years. So that always needs to be checked. Then tenant and landlord obligations, as Dave said, is it a fully repairing lease? Is the tenant responsible for the repair of the business and the ongoing maintenance, or is that a landlord cost? Who's going to insure it? Again, does that fall on the tenant? Usually in commercial leases, the standard is fully repairing and insuring, but sometimes there are other variations, so we would check that. If all that stacks up, then fine. If not, then we will look to go to the valuation report to see what their recommendations are. We will look at the market rent, and if the property would come vacant, what does the valuer think the replacement rent would be, and how long would it take to find a source of suitable tenant to get that rent back in place. So onto the valuation report, that's important because it enables us to form a real strong opinion on the likelihood of us being able to recover our debt in a default situation from the relet or the sale of the property. We look at the numbers, which are often thought the most important, but it's not always the numbers. It's more what lies behind those numbers that's really key. So we'll look at things like the asset characteristics, what's the area like, what's the condition of the property, is there any capex? So, okay, it might be all right now, but if the roof's going to fall off in 10 years' time, has the customer got the sources to replace that? And then again, demand. If we had to sell it, or the client had to re-let it, how long? What's the opinion on how easy will it be to get a new occupier or an investor or a purchaser to sell the property? Then the comparables, are these relevant? Has the valuer looked at relevant other examples of assets that have sold in the area? Are they close to the property? Are they similar? I recently had a bed and breakfast where the valuer had actually used houses. So we had to push back and say, well, actually, this is a bed and breakfast. If we sell it, we can only sell it as a bed and breakfast because that's the planning use. why are you comparing 5 and 6 bedroom houses? Because that's not going to be able to just go in an auction and sell Monday to Friday as is. It's not realistic. So we will always have a real strong look at those comparables and make sure that they are relevant, and the valuer has really used the right numbers. We also look at, have they used the relevant calculations? So last week I had a report where they had it was a house in Lytham, I think. There were no other houses in the area of that size, of that value. So he didn't have any comparables. So what he'd done was then gone, right, well, it's however many square foot. If I say it's worth £100 a square foot, this is where we've got to. Which in some respects is the right way to do. But in others, actually, if there's no other houses and nobody, you can't demonstrate that anyone else has bought a house like that, how do you really know? So it's just drilling down really into how have they got to the numbers, and do we think that that's a realistic view? And finally, the photos. It sounds like an obvious question, but occasionally you're flicking through and the photographs aren't there, or they don't show that it's realistically what we're expecting, or there might be things in those photos that show things that haven't been commented on in the report, cracks or just tenants that we weren't expecting to be there. So that's another key consideration.
Thank you, Emma. It's funny that sometimes we do see reports without a photo of the actual security. And finally, what additional relevant information do you incorporate into your credit report, and what do you require from brokers and their clients to facilitate a prompt decision from our credit committee? Because sometimes time is certainly precious with these transactions.
So what I would say on that is the more information that can be provided, but in a simple and straightforward way, not pages and pages and pages of an email, up front, the quicker we can come back and with a more precise answer. Because sometimes you look at something high level and go, oh yeah, that's fine. You missed out a key bit of information that then can unwind the decision 6 weeks down the line when your client's paid for valuations, etc. Obviously, none of us want that to happen. So basics, who is the customer? What's their experience? Credit worthiness is the main thing. And that sounds really obvious, but the number of times we get requests where we haven't even been told the customer's name or what the property address is, is unbelievable. So really, who is the customer? What's their experience? What's the ask? What are they asking for? How much do they need? What product do they need? Sometimes we do just get a default, because we are widely known as a bridging lender, 12-month bridge. Well, actually, do they need a 12-month bridge, or do they need 9 months? Do they need 18 months? Is it realistic? Do they even need a bridge at all? Are you putting them on a bridge just for speed, when actually day one we could just term it out? So yeah, what are you asking for? Where is the property? What's the address? What's the type? I once had one come through that was a house, or looked like a house. When you looked at it, it was actually a graveyard. But it was just an address on a piece of paper that actually everybody, until we'd got quite a bit way through, had assumed it was a house. It wasn't. So yeah, where and what is the property, and what is the type of the property is quite key. Why are they doing it? Why do they need the money? Is it a refinance? Is it a purchase? If it is a refinance, what did they have the money for in the first place? And then when and how are we going to get repaid is the key thing, which, like I say, all sound really obvious, but very, very often are missed.
Fabulous. Thank you for that, Emma. And if anybody's got any questions for Emma, please, again, raise it in the chat box and then we will cover them in just a moment. So finally, we've talked about a lot of opportunities there, and Tanya certainly mentioned some great things that we've delivered, and she also mentioned a VIP product. So certainly do reach out if you're interested in that. But what I'm going to do is bring to life some of our USPs, and not only USPs, things that we do that aren't necessarily written on our product cards, to let you know the art of the possibility. So just got 2 case studies for you. So the first case study was an SPV purchase of a semi-commercial property. We were also doing a transfer of equity of another property that they already owned, with capital raising of said semi-commercial property also. So 2 semi-commercial properties in this transaction. Now, the first one was a ground floor off license with a 2-bedroom flat located above. Now, one massive thing together is that we can consider so many different property types. And with your semi-commercial properties, things that we see is flats above, properties where there's a flat above a hairdresser's or a takeaway. Many security types are accepted by Together, so just factor that in. And then this was a bespoke agreement that we accepted with this. Tanya mentioned earlier that we can look at, on exception, a desktop valuation for semi-commercial properties as an example. This particular case, because there was a need for speed, we agreed on the purchase itself to release 65%, with the valuation to follow post-completion. That isn't standard, but that's something bespoke that we agreed on this deal because of the overall value and profile of the case. And then Security 2 was a ground floor cafe with a 2-bedroom flat located above. Now, being able to utilize the equity in Security 2 that they already owned meant that we could lend 100% of the purchase transaction. And just a thing to note that is not on our product plans is if you were looking to raise a second charge commercial, because you've got a first charge that you don't want to look to redeem onto another transaction because of rate or early repayment charges. Whilst it's not on our plans, we can create a bespoke offering for second charge commercial mortgages. That's both on bridging and on term basis. And then, as we mentioned, it was a transfer of equity. So we were transferring from a previous limited company into this SPV. And one of the USPs that we talk about more often than not at Together is that we can lend for too many different entity types. So what I mean by that is limited companies, LLPs, but also things like SIPs, SAS, and trust. So those last 3 sometimes can be a bit more complex. So we ask you to provide us with the documentation for us to review those, but we certainly can support with those types of entities. And the transactions completed simultaneously within 2 months, which actually was quite a fantastic timeline for a purchase of a commercial asset. So the customer is certainly working with a great solicitor to enable that speed. So in that scenario, we've agreed an exception on the valuation to follow post-completion. We've lent against a property that perhaps some lenders might be concerned with, because they may be concerned with who wants to live in a flat above an off license that's open till late. And also the lending structure, being able to do a transfer of equity and cross charge to enable 100%. But as I mentioned, we can consider second charges as well on commercial assets and semi-commercial assets. It's just not on plan, but this is where you need to pick up the phone to a member of the team and we can help you with that. Now, case study 2. So Tanya mentioned that we have on our product plans increased the loan size numerous times for our appetite. And actually this case was over that loan size, right? So we mentioned maximum £5 million, but on this particular case we agreed 6.1, a £6.1 million refinance. So yes, we have got appetite to do beyond what's on our plans, beyond potentially what we typically look to do, and we certainly have got appetite for these larger transactions. Now, this property was converted. It was a past car garage, and it's converted into mixed use, so office sales centre with serviced office, and also some warehouse units, light industrial and storage there. Now, the key part on this particular transaction itself was that there was a really complex company structure in this. The shareholdings were another company. It was a company within a company within a company, so really complex transactions. But that's where you work with a common sense lender and fabulous underwriters like Emma to review those complex structures and help guide you through this. And in addition to that, a new director was being added at completion, which we were comfortable with. And another element to this is one of the companies that had shareholdings in the limited company that was refinancing the property, they were looking to completely buy out that company. So part of the funds was for that. Now, we can lend for many purposes, legal of course, but we can lend for many purposes for raising finance. So just bear that in mind, that things like purchasing shareholdings is definitely doable amongst many, many other examples. And then you'll see there that one of the company directors was an overseas national. Now, in a past webinar, it feels like a lifetime ago, but in a past webinar, we talked about overseas nationals and expats, because here at Together, we have got a fantastic KYC team that works with our partners on reviewing those overseas nationals that perhaps are in higher risk countries. So subject to extra due diligence, we can get comfortable with these types of transactions and those types of the customers that are either reside or their nationality was from the higher risk countries, and also expats wherever they're currently residing. There may be some extra due diligence on where that actual country is, but we can help. And another point to note for one of our USPs is that they don't need to have an existing property in the UK to be able to transact with us. Now, this was a really bespoke thing that we agreed on this particular case because the property did not benefit from planning permission for the current use. We found out quite late in the stage of this application for this challenge, but you know what? We identify that sometimes some things don't necessarily go to plan at the 11th hour, and that's where we work with you. Of course, we'd like to know this information in advance as best as possible. But if, for example, there's a situation where we need to consider indemnity policies, which we did on this particular case, we agreed a planning indemnity policy, then we will certainly work with you on that. There's other types of indemnities that we see day in, day out, so the likes of no search indemnity policies. That's something that our internal legal team, and of course priority law, that we also work for some complex transactions, can certainly guide you and guide your customer's solicitor through. And another thing that was outside of criteria, so look at us, how many things we've gone outside of standard criteria on these two cases. But this was another thing, because on our product plans that you'll see, our maximum LTV for a refinance is 65%, subject to the property type. Now, in this particular case, we agreed a gross lend at 68%. So there always is flexibility there. And not only does that go for VIP pricing that Tanya mentioned, it goes for the likes of agreeing things that perhaps just don't fit the mold. And that mold also includes the mold that's on our product guides. So we have, as we say, we've got some fantastic team of underwriters, but also our telephony team and your field-based BDMs that have extensive level of knowledge that can guide you through these complex cases, because we are a yes lender here to help you and find a way to structure a transaction.